One of the reasons why you lose with options because of pricing. Stocks aren't priced to lose. Stocks are just priced the way they're priced. It's just the stock price. Now, can they be overinflated and overvalued? Yes, but the price is the price. When you buy $100 stock, you're buying $100 stock. When you buy an option on $100 stock, it's jacked up with premium. So that, let me show you just so you can visually see what I mean. Let's look at, well, I guess we'll look at the SPY for next Friday. Price is sitting right at about, it's 599. Those poor 600s, all those 600s, what a shame. Price is at 599.14. The expected move for next Friday is $9. Well, I don't know if I believe that, but $9 nonetheless, right? So that would take, if you took, 599.14 and added $9.30, the market maker is pricing in a move of $9.30. Let's just say that's what he's pricing in. Okay, fine. So if I decided I wanted to buy an in the money call, the 598, how much is that 598 call worth? Can somebody tell me? This 598 call for next Friday, how much is that really worth? Anybody? No, it's worth $1.14, because if you were to, let's just say price opened on Monday at 599.14, and if I decided to take possession of the 100 shares of stock, I would own them all at 598, wouldn't I? Wouldn't I own the stock at 598? Well, if the stock is trading at 599.18, then it's worth $1.14 a share. Or I should say, I've got $114 of equity, or $1.14 per share of equity. So the real value is $1.14. But look how much the options are priced at. $5.35. So that means there's $4.21 of premium. Holy cow. Like, that's almost 4 times the value. That's insane. And you know why it's so high? It's because of volatility. Because price surged higher, and the S&P futures got over 6,000, right? So, there's a reason why it is priced so high. So if I were to buy this on Monday and spend $535, I would need, for price, in order for me just to break even, I would need price to be at 603.35. Because if price finished at 603.35 on the 598 call, I'd have 535. Well, that's what I paid. So that's my break even. Now, the market maker says it could go up to 608.44. We'll see. But chances are, throughout the course of the week, let's say it goes up, 601, 602, 603, 605, 604, 602, pulls back, 601, all the while that it's undulating throughout the week, this premium is burning down, is less and less and less and less, until by Friday, it's gone. It's almost completely gone by Friday morning, which means what you're left with is just the true value. So let's say I'm right, and price gets to 603 by the end of the week. Went from 5.99, it went up $4 to 603. Well, I lost, didn't I? I will have lost $35, made no money. Market maker wins. Because this pricing is just insane. So one of the ways that we can beat the market, so to speak, or at least attempt to, is, well, what if I did the 598, but then I sold, let's say I sold, what if I sold the 602s? Wow, I just took the price less than half. I went from 530 something, 535, down to 213. And I still had the opportunity, if I wanted, if the trade works out, I still have an opportunity to make almost a couple of $100. What if I altered the strikes even further? Move this to 599, went at the money instead of in the money. Don't mind paying a little premium, but drop it down a little further. That might work. I could even go to the 600s. And now, even money. That's more of a fair fight, isn't it? Isn't that more of a fair fight? And oh, by the way, 601 is my break even. If the market maker is saying 608 is where we'll probably end up, that's the expected move. And before it was going to be like 603.35 in order for me to break even. Well, now I can break even at 601 and I can double my money. You see that? So last scenario is, this makes more sense to me. 605. It's still less than the expected move. It's a 5-wide vertical. I can invest 218. If I can get a little, maybe a pullback at some point in the morning on Monday, maybe I can get this thing for like 210 would be a good price. 210, make 290. If I'm expecting the price to go up, then why not buy a credit spread? Well, you could buy a credit spread with premium being so high. You could. That could be part of your strategy if you thought price was going to continue to go higher. It's just a lot more risk to do that. But I'll share with you a combo. So this is pretty good right here. Risk 210 to make 290. I'm within the expected move. That's within my allo. I'll get out if it goes down by 70%, or if I lose, we could look at the chart and see what levels we would want. Maybe 590, maybe 598 or 597. You lose 596, and then you're out. Well, you'd have to look at that. So this is one part of the equation. And I could say, you know what? I'm going to put this out for 620. I'm going to give myself an extra week. So if I do that, how much more is it going to cost me to go out another week? Not that much more, right? On a little pullback, if I could get this for maybe 2.25, that's still kind of within my range, right? 2.25 to make 275, it's still good, and I've given myself an extra week. But the price is still a bit much. So there's a few things I could do. If I thought price was going to continue to be bullish, then I could go down here for, let's say, Wednesday maybe? I could go to Wednesday. That is Wednesday, right? Yeah, I could go to Wednesday and say, as long as price stays above, let's go to the put side here, 595 by Wednesday. Because most likely with, remember, you got to always take the entire market setup into consideration. Now that price is over 6,000, there's going to be a lot of FOMO traders that missed out on the move. They're going to want to come in here and buy because they think, well, we finally got over 6,000. Buyers are going to come in, probably going to go higher. So what if I sold the 595? Let's see, a 2 wide. That's not bad. What if I did that? If I sold the 595, 593 put credit spread, because I don't think price is going to drop below that by Wednesday. Monday, Tuesday, Wednesday, I think we're going to stay over 600. Might not get all the way to my trade, but again, I'm giving myself till the 20th. I just want to bring in some premium here. Well, a little too risky. Go to 594. Too wide. Still don't like it? Go to 593. Too wide. That ain't bad. Maybe you want to go to 592. Does anyone think the market's going to go to 592? And also I'll do this 3 wide. So look at this. 32 cents of credit. So I could do the 592, 590. Now remember, 599 is the current price with the expected move being $9, plus or minus. I think it's going to go up. But even if it went down almost the expected move, I mean, you could do the 592, 590 put credit spread and bring in $32 of credit. And as long as price stays above 592, this credit of $32 is yours because this would expire worthless. So now remember that 225 nice 5 wide for the 600, 605? Subtract $32 and now you tell me if that's a good deal. So maybe I can negotiate and get this thing down to 220 at some point. Maybe I can negotiate and get this to maybe 35. So if I work the market a little bit, the total trade would cost me 185. So 185 for a SPY, think about it, 600, 605 call debit spread, and I have 2 weeks for it to come to fruition. You see what I just did here? So my burn level was 300. My pilot is 200. Well, let's say my pilot was 250. I could absolutely have just traded 230, which was the original cost. But I'm going to negotiate and see if I can work the price down to 220. I got a cut loss, an exit strategy to get out. I just reduced my cost with this a little bit. Don't really need a hedge yet, right? Don't need a hedge yet. But this is pulling together all of the components, not all, but most of the components that we talked about earlier. We have a setup, and the setup is we're over 6,000. That's the setup. And you're going to see FOMO traders maybe come in. We've hit a technical level, whatever it is. Setup, I got. My burn level turned into my pilot, which gave me the trade. I could trade up to 250 if I wanted to, but I altered the strikes to fit my allo. So 230 is what it came to. I'm going to try to work the price on Monday to get 225 for it. Great. I've got an exit strategy. I'm going to get out. If it goes down by 70%, I'm out. If I lose 595, I'm out. And that's on an hourly close, let's just say. It's my strategy. I know where I'm going to add to the trade, right? If I get to 603 on an hourly close, I'll add to the trade a little bit in some fashion. And I've reduced my cost by adding this cute little thing for Wednesday. This is options trading at the highest level, guys. It's really not that complicated, but I'm telling you that the things that we've talked about here, 99% of the options traders out there, by the way, that lose money, don't do this. They don't have what I shared with you at the 10 o'clock. Allo, exit, add, reduce your costs, and learn how to hedge. If you can learn this aspect, which is the how to trade, it'll put such less emphasis on what you trade. And oh, by the way, the what you trade, I'm giving them to you. This is the key. This is the keys, actually, to the kingdom.
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comment section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.